Hi everyone, I'm Debbie Roberts, owner and financial advisor at Property Apprentice. Join us today for the Week in Review, where I talk about current events for the everyday investor and home buyer. Our topics for this week. Topic number 1 from Stuff on the 31st of July, tax warning for property flippers. Topic number 2 from One News on the 30th of July, Explainer, the changes coming for the process of borrowing money. Topic number 3 from RNZ on the 30th of July, is a capital gains tax the answer to unaffordable renting? Topic number 4, NZ Herald, 31st of July, ANZ cuts home loan and business interest rates. And topic number 5 from RNZ on the 1st of August, banks relax borrowing test rates. So first up this week from Stuff on the 31st of July, tax warning for property flippers. Buyers and sellers of properties for profit are cautioned about potential tax liabilities, even if they hold the property for over 2 years or have lived in it. The bright line test duration is now 2 years, implying that investors are not automatically taxed for gains if they hold a property for at least that period. However, tax expert Robin Walker, a partner at Deloitte, emphasised that not everyone is exempt from taxation under this rule. Inland Revenue, IRD, has introduced a tool to help individuals determine if their property transactions are taxable under any land tax rules. This includes those who buy with the intention to resell, regardless of the holding period, or if they have a history of buying and selling, potentially classifying them as dealers. Speculators who frequently buy and sell properties are a primary focus. Any property purchased with the intention of sale can be taxed, independent of the bright line test. Walker highlighted that Inland Revenue has an information sharing agreement with Land Information New Zealand, LINZ, enabling them to identify suspicious transactions. IRD tracks the number of sales a taxpayer makes and monitors for patterns, such as selling more than 3 properties in 10 years. There is no fixed rule on the number of transactions before taxation, but generally a pattern is identified after 3 prior sales. The purpose of each transaction is irrelevant. The similarity of transactions is crucial. Walker noted that IRD can quickly identify frequent property turnovers. Those buying properties with the intention of resale, even if they're living in them temporarily, might believe they qualify for a main home exemption, but this can be overridden if the intent is to flip the property after renovations. IRD's sophisticated computer system can detect connections between taxpayers, even if properties are distributed across different names, IRD numbers, trusts, or companies. This system can initiate information requests based on detected patterns. Taxpayers must then provide evidence explaining why they believe they're not subject to tax. Holding properties for more than 2 years can still establish a pattern, raising concerns. Walker cited an example of a couple who bought and sold 11 properties over 12 years, each time citing different personal reasons. Despite their excuses, the properties were all on the same street, illustrating the type of scrutiny IRD applies to determine the true nature of transactions. My advice would be, if you're thinking about purchasing a property with the intention of selling it, make sure that you get some good tax advice on that, because not only can it trigger tax, it can also trigger GST on the transaction as well. And so talk to a good property accountant before you enter into the area of flipping properties. Topic number 2 from One News on the 30th of July, Explainer, the changes coming for the process of borrowing money. Here's what borrowers need to know about the government's updates to the Responsible Lending Code. Anyone applying for a loan undergoes financial checks as part of the Responsible Lending Code, which was established in 2015 and is updated periodically. What is the Responsible Lending Code? The code, issued under the Credit Contracts and Consumer Finance Act 2003, commonly called CCCFA, addresses concerns about lender behaviour. Banking expert Claire Matthews explains that the code ensures borrowers are lent money that they can afford to repay and that contract terms are fair. What are the new changes? The main changes impact Chapter 5, concerning rules lenders must follow to determine what a borrower can afford. Matthews noted that recent versions of the code had become overly explicit about what lenders needed to scrutinise. The government is now easing some of those requirements. Previously, lenders and borrowers were concerned about the detailed checks on spending habits, such as accounting for every cup of coffee. While Labor relaxed these checks a year ago, the rules were still seen as too restrictive. The new version allows more flexibility, focusing on significant expenses like debt repayment and insurance premiums rather than every minor expenditure. What do these changes mean for borrowers? Starting from the July 31st, borrowing should become easier. Matthews noted that the previous changes had reduced lending activity. The relaxed rules could make it simpler to obtain loans, particularly for first home buyers. Borrowers will still need to show their regular expenses and discuss accommodating a new loan, but won't have to justify every minor spending choice. Previously, borrowers were advised to cut discretionary spending months before applying for a loan. The new rules reduce the need for such artificial financial management. Are there any risks to easing the code? Some financial mentors worry the changes could lead to more irresponsible lending. Sam Garraway, CEO of Christians Against Poverty, expressed disappointment, noting an increase in calls from people struggling with debt. Matthews acknowledged the risk of less reputable lenders exploiting borrowers, but believes the code, while necessary, had previously been too stringent. What we're seeing in the lending world is that banks' lending criteria has certainly relaxed over the last few weeks and certainly since the 1st of this month. So, good to see that it is not quite as restrictive as it had been previously. If you'd like to learn more about investing in property, join me at one of our free events called How to Succeed with Property Investing. I'll discuss strategies for successful investing from my perspective as a financial advisor, and these events are available live, online, or in person. Check out propertyapprentice.co.nz for upcoming dates and register today. We don't sell property, so it's all about increasing your knowledge to reduce your risk. If you've already been to one of our free events and you'd like to find out more about how we can help you to reach your financial goals, you can also book a no-obligation phone call or meeting with my husband, Paul Roberts, via the website. Topic number 3 from RNZ on the 30th of July is a capital gains tax the answer to unaffordable renting? Affordable rental properties are becoming increasingly scarce, prompting renewed calls for New Zealand to reconsider implementing a capital gains tax. Research commissioned by the Child Poverty Action Group examined the affordability of various rental housing sizes for households with middle incomes, low wages, and those on benefits. Rent was deemed affordable if households could pay it while still covering basic living costs. The report revealed a significant decline in affordable rental housing for low-income working families between 2018 and 2023. Coincidence? I think not. Northland saw a 14% drop, Bay of Plenty 11%, Gisborne 14%, Manawatu Whanganui 22%, and Southland 26%. Nationally, only 33% of 3-bedroom homes and 62% of 1-bedroom homes were affordable for such households in 2023. Report author Greg Waite noted that 12 out of 16 regions showed substantial decreases in affordable rentals. He highlighted that while apartment construction has increased, larger dwellings are being redeveloped or upgraded, making them unaffordable. Waite attributed the declines to inadequate housing policies and the absence of a capital gains tax, which he argued incentivises overinvestment in property aimed at resale profit rather than new construction, driving up prices first in major cities, then in regions. I'm not sure I agree with his arguments, and I'll tell you why shortly. He also pointed out that rental returns fall as prices rise, but are bolstered by significant tax deductions for landlords on interest payments. I also don't agree with his comments on that. Additionally, tax concessions for large-scale investments and expensive rent-to-buy apartments exist, but there are insufficient incentives to build new affordable homes for lower-income households. Despite recent regulatory changes encouraging the construction of smaller rental properties, Waite said that the future direction remains uncertain. He anticipated that rents would continue to rise faster than inflation. Stats New Zealand reported that rents increased by 4.5% on existing properties and 2.5% on new tenancies over the year to June. Waite suggested that New Zealand should reconsider discussing a capital gains or wealth tax to address these issues. I'm so confused as to what his reasoning is there. He emphasised the need for a balanced mix of policies to manage housing prices, noting that New Zealand has some of the most unaffordable housing in the world, and second only to Finland in rental affordability issues. Regionally, affordable rental properties for low-wage households declined in most areas except for 1 and 2 bedroom homes in Auckland, 4-bedroom homes on the West Coast, and overall availability in Canterbury for 2 and 3 bedroom homes. One Wellington tenant, Jamie, mentioned that finding an affordable house often meant compromising on living conditions. She lives with 8 others, paying $225 each per week. Jamie noted that as a full-time student working part-time, the rent is substantial, and half the rooms in her house receive no sunlight. However, she acknowledged that her landlord could charge more and people would still pay. Green Party spokesperson Tabitha Paul called for more public housing, noting that affordability issues extend beyond main centres. She pointed out that regional residents face unique challenges, including limited access to social support services and public housing, highlighting the widespread nature of the housing crisis. My thoughts on this are that introducing a capital gains tax, while not necessarily the end of the world, is not going to help with rental affordability. If anything, it will make people think twice about investing in property. And what we need is more private investors providing rental properties. The only way to bring market rents down is to have more rental properties available, supply and demand. And so introducing a capital gains tax might make people think twice about it, although I suspect that the majority of experienced long-term property investors, a lot of them have absolutely no intention of selling. And at the end of the day, even if there is a capital gains tax and you sell a property for profit, you still keep the majority of it. So, it's not the end of the world if they introduce a capital gains tax. Just don't use it as the reason for why rents have been on the increase. Rents have been on the increase because we don't have enough private landlords in this country. Private landlords provide about 80% of all of the rental properties in New Zealand, and a third of our population live in rental properties. We need more investors, not less of them. Topic number 4 from New Zealand Herald on the 31st of July, ANZ cuts home loan and business interest rates. ANZ has reduced its business lending, floating and fixed home loan interest rates. This marks the second rate cut by the bank within a month. 2 weeks ago, ANZ lowered its standard fixed-term rates for periods ranging from 6 months to 5 years. The 3-year special fixed rate will decrease by 36 basis points to 5.99%. Special rates apply to customers with at least 20% equity. The floating variable home loan rate will drop 15 basis points to 8.49%, and the business floating and business overdraft base interest rates will also fall by 15 basis points. Lorraine Mapu, ANZ New Zealand's Managing Director for Business and Agri, stated that most business and agricultural customers are on floating rates, so the reductions will benefit them quickly. She acknowledged the challenging environment for business and farming customers, noting the tough New Zealand economy and volatile global markets. Mapu attributed the rate cuts to the Reserve Bank of New Zealand's recent official cash rate announcement, which led to lower wholesale rates, allowing ANZ to pass on savings to customers. In the past month, all major banks have reduced their home loan rates, with some banks making 2 cuts. Grant Nucky, ANZ New Zealand's Managing Director for Personal Banking, highlighted that a quarter of market activity in June involved customers switching banks to take advantage of the competitive rates. He noted that many people who fixed their home loans on shorter terms in recent years would soon be able to benefit from the lower rates. Additionally, ANZ decreased savings rates by 15 basis points and term deposit rates by 10 to 30 basis points for terms of 1 year and longer. They give with one hand and take with the other, don't they? But it is what happens when interest rates decrease. It also decreases in savings accounts as well, and that would be across the board. So it's certainly something of interest to note that the financial markets have been factoring in and OCR reduction sooner rather than later. And swap rates have certainly been dropping like a stone. So, good to see. And it increases the chances that the Reserve Bank might reduce the OCR as soon as possible as well, especially once they start seeing the data to back up what all the financial markets are expecting. Last topic for this week in review from RNZ on the 1st of August, banks relax borrowing test rates. Banks are relaxing the test rates used to assess whether borrowers can handle home loans with further reductions anticipated. Test rates, which are set higher than current interest rates, ensure that home loan applicants can manage potential rate increases. At the moment, previously, banks were testing your affordability at around 9% interest rates. Recently, two major banks cut their test rates by approximately 20 to 25 basis points, and this follows a decline in those wholesale rates driven by expectations, as I mentioned, that the Reserve Bank will start lowering the official cash rate towards the end of this year. The mortgage advisor, David Windler, expects other banks to follow suit. He noted that the impact of these test rate reductions depends on the applicant's total debt. For instance, if a borrower with an existing $1 million mortgage applies for a new $500,000 loan, the lower test rate could significantly affect their surplus, potentially making the difference between loan approval or denial. Windler pointed out that while a reduction in test rates might only adjust the surplus by about $80 for a $500,000 loan, it could have a more substantial impact for investors with significant portfolio debt. Mortgage advisor Glenn McLeod indicated that these changes would ease borrowing conditions. He also mentioned recent adjustments to the Credit Contracts and Consumer Finance Act regulations, which now allow applicants to avoid providing detailed proof of rates bills and insurance costs, saving mortgage advisors significant amounts of time. McLeod suggested that as servicing rules become more relaxed, debt-to-income ratios will become more crucial. He expressed surprise at the timing of the rate cuts, indicating that banks must be confident in their interest rate predictions. Additionally, he noted that tax cuts have been incorporated into lenders' calculators, effectively providing borrowers with additional financial flexibility. If you're ready to take your property investment game to the next level, join us for our exclusive event called How to Succeed with Property Investing. Whether you're a seasoned investor or just starting out, this event will provide you with the tools, strategies, and insights you need to thrive in the property market. As an experienced property investor and a financial advisor, I'll share valuable insights and expert tips to help you on your journey. Our free events cater to all levels of property investors and first-home buyers, and I'll also tell you more about how we help our clients to achieve their financial goals. So if you're interested in finding out more about what we do, go to propertyapprentice.co.nz today to register for one of our upcoming events and secure your spot. Alternatively, you can book a no-obligation phone call or meeting with my husband, Paul Roberts, through our website. That's propertyapprentice.co.nz. Thanks for listening.